the inverse of that was in the Asia crisis, and we went to Asia in the mid '90s and started looking for good businesses in Asia, and particularly in Korea and in Thailand, Hong Kong. And luckily we could see there were real financial issues developing in Asia, so we didn't do much initially.
But sorry to interrupt, but what took you to Asia in the first place?
Yeah, so I was really lucky. I have a good friend named Gifford Combs, who was going over there with some people that were involved with Soros, and he was kind of tagging along, and he invited me to come. He said, "You won't believe the value. You won't believe what's going on here. You won't believe the valuations." And I want to come back to this because it's part of one of the ways we look at good businesses. The Asian economies were all growing, and in those days, Korea was growing really fast. Thailand was growing fast, and I hadn't seen anything like this. This is really the growth of these economies, and therefore some of these businesses was quite exciting. And so we went and looked, and we could go into great detail about all the stuff we looked at. But the point is, in the Asia crisis per se, we basically avoided most of that. But I started buying stocks as the Asia crisis pushed things down, and there was a small brokerage firm in Korea. It was run by a guy who was actually a North Korean refugee who'd been there, and he came over, and he had this small brokerage firm, and we got to know these people pretty well. We talked to them a lot, and the stock was a simple balance sheet with mostly bonds, government and corporate bonds, and some cash, and then it was leveraged 3 or 4 to 1. Bear Stearns was 30 to 1.
Yeah,
or these guys were 3 to 1. And when the crisis hit all the brokers because of their brokers, and the stocks went down dramatically. So this thing was at about 60% of book value, and it pretty quickly went down to 30% of book value. Well, that's pretty attractive. So yeah. I bought some more. And then it got cut in half. And this, by now, Korea is just collapsing. This was late, whatever it was, 98.
Yeah.
And this was real. And I knew the company. I knew the balance sheet. There's nothing wrong with this stock. It's fine. So I bought quite a bit more. And within a month, it got cut in half again. So we're now down to like 8 or 9% of book value.
Yeah.
I've never seen anything like this. These are leveraged bond portfolio at high quality bonds at 9% of book value. So I bought some more, and ultimately it worked out. The stock went up 10 times.
But mentally, this is what I'm so fascinated about, because this is the modus operandum of a short seller, of a value investor, I beg your pardon, is clear. It's straightforward, and it looks so easy. As I said that when I'm talking to Dave Ivan, it sounds so simple. It looks so easy, but the battle up here, even though you know that company, you know the balance sheet, you know the people, how do you deal with that when you've had something cut in half and half and half and half?
Well, I'll tell you, it was scary. I don't want to sugarcoat it, but I think this is one of the things that we do. I think a lot of value guys do that's different than most others, and that is we're very much involved in the research.
Yeah,
we're very much involved in looking at the company, talking to the managements, and that gives you a level of confidence in what this really is.
Yes,
and I think one of the things that bear markets scare people out of positions because they don't really have confidence in what it is that they're owning or buying. And so we think it's really important that portfolio managers are also analysts and get involved with the managements as well. We're involved with some things right now where the stock was going down every day, and it was one of these things where, well, what are we missing? Well, we don't think we missed anything, but it is hard to do because certainly if you're not really knowledgeable about the asset and the business and so on, you can get pushed out of these things. So that's one of the answers. The other thing I think is just personality. I just, for whatever reason, have this streak that I'm a contrarian in general, and the worse things are that people think they are, so the more comfortable I am in doing it. And conversely, the more comfortable people are, the less I am in what's going on. So I think that's a personality trait that, some of the people I know that are pretty good at this have the same defect that I do. But I sometimes think, thank goodness I found this line of work because I couldn't do this and a lot of other things. But these were some of the real crunch points in my experience that were really required me to think very carefully about, first of all, did you make a mistake?
Yeah.
And secondly, if not, how much more of this can you take? How much more of this do you want? The arithmetic here, I think, is for me is very appealing. We get a lot of people that talk to us about volatility versus risk, and as you know, value investors think risk is not volatility. They think volatility is not
Correct.
risk. So this was a very volatile stock, and this is a good example of the kind of distinction that I think value investors make. If you think about this particular company, and if you think about what the assets were, and forget about the business. The business was okay, but it wasn't great. But just think about the assets that you're buying at what price. I think a lot of people today that think volatility is risk would have taken this experience and say, at 10% of book value, this is a very risky stock.
Yeah.
We come to the exact opposite conclusion. The idea is that as a price of an asset goes down, it is less risk, not more. Even if it goes down, whether it goes down quickly or slowly, if it's going down, it's getting less risky, and the speed with which it goes down is irrelevant to us. So we don't think this was. I don't know what the volatility on this stock was, but it was very high in those days. I think it was getting less and less risky as it goes along. But in addition to that, the expected return is going up.
Yes.
So this is value investing is one of the only strategies I know of where you simultaneously, as things get cheaper, reduce the risk and increase the particular expected potential return.
The thing that strikes me about that, because I agree with every single word you said there, but the X factor, I think, if you go back to the Asian crisis you said there, you go back to that list you made at 10 o'clock at night, you did the work before, so you were ready. You knew what you wanted to buy. I think if you already own these things, that's why I'm very interested in your thought as it got cut in half and you're long the stock. It's very easy if you've got a list of things that you want to buy when they go on sale. You're rubbing your hands as the markets are falling. When you're long the stock and it's getting cut in half, and so's the value of your stake, that's a much harder thing to step in and say, the risk is going down, this is great.
Depending on how much liquidity you have left, that's really a critical question.
Yeah.
And we oftentimes use this example when we're interviewing young people and say, if you buy a dollar bill for 50 cents, which is what value investing supposedly is it a good thing or a bad thing if it goes to 40 cents? And the answer to that question is oftentimes revealing of the candidate that we're looking at, because most people will say, well, it's a bad thing. Well, it depends. The answer is it depends.
It's your time frame. It's always time frame.
Have you got any more liquidity?
Yeah.
So you'd be unhappy if you spent all your money on this before. But if you've still got some more liquidity, at 40 cents, you get this dynamic I was just describing. You have now, instead of making a potential 100%, 50 cents on 50 cents, you now have a potential 150%.
Yep.
Where you make 60 cents on 40 cents. And simultaneously, the risk is less. So the more that happens, even if I already own it, I'm not unhappy about it so long as I've got the ability to put more money to work in that position. And the position is getting smaller. Now, the inverse of that's true on the short side. That's another reason that shorting isn't the inverse. But as a position in your portfolio goes down, it gets smaller and it gets more attractive simultaneously.